Thank you very much. Sorry for the technical problem. Aeimit?
Yeah, thanks for organizing this, and thanks for inviting me. I had like a really long, nice motivation set up for why we should worry about this, but in fact, it's already been done in just the previous paper. So I'm going to keep it super short, and actually even starting late, I'll still try to finish ahead of time. But basically, the question is exactly the same, which is that we have a lot of work on identifying monetary policy using high-frequency data for the US and the Euro area, and why should we not try to do that for other emerging countries? And so when I started working on this a couple of years ago, there was not much work here, but now, of course, there's the paper that we just saw in South Africa, but there's some work on China, Brazil, Chile. So this seems to be quite a fast and growing literature. And so I'm going to tell you about whether it makes sense to do this in India. Okay, so again, I'm going to speed through some of the stuff because hopefully you're now very familiar with the things that you've seen in the previous presentation. But please stop me if you have any questions. Okay, so just a broad overview of what are the challenges you might face when you try to do this for India. Or sometimes it's intentionally vague. And so the challenge is, can we do these sorts of forward guidance shocks for emerging countries where the central bank communication policies, it looks quite different. And then finally, there are typically, if you look at a long enough sample, there'll be changes in the monetary policy framework. And does that matter, and how should we think about that in terms of doing this high-frequency stuff? Because we're trying to do this high-frequency analysis for India, keeping in mind these sorts of questions. Okay, so a quick overview of what we do. We're going to use OIS rates. I'll explain to you in a few slides what these are. But these are basically swaps where you can get a sense of what the market thinks interest rates will be in the future. And we're going to use data on these swaps and see how they behave on the announcement days of the Reserve Bank of India. And then we'll try to see if it makes sense to do any sort of forward guidance shocks to extract some measure of, is there any surprise communication happening on these announcement dates? And then as part of this paper, we're not only making the shocks public, but a big part of doing this paper was actually just getting the announcement dates for the Reserve Bank of India, which in the early part of our sample were quite hard to track down. So we're making it available. Hopefully other people want to do stuff on India, they can use this. And then to understand this idea of, is this data reliable, we're going to spend a lot of time, or we spent a lot of time in this paper doing a narrative analysis, which was kind of a two-pronged approach. So we first read through all the statements. Some of them are quite long, like multiple pages. But then we also read in detail what the media discussion is the day before the announcement and then the day after the announcement, to see, like, according to the media narrative, what were people expecting the RBI would do, and then look at the discussion in the media of how they reacted to the RBI announcement. And we're trying to, it's a subjective exercise, but we're going to try to see if this media reaction is somewhat consistent with the OIS rates. And the short answer will be that for a good chunk of the sample, yes, but then for some part of the sample, we'll find that it's not, and I'll get into that. And then, as we saw in the South Africa paper, we're going to use this to study monetary transmission. That's the eventual goal. We're going to do just like a basic first pass at this. So we'll look at how financial markets respond to these shocks. We'll also see how real variables respond to this shock. But this is very, very preliminary. So there's definitely more work that needs to be done over here. OK, quick preview of what we find. So we find that these OIS rates respond a lot to RBI announcement dates, but it's not the case that all RBI actions are completely a surprise. So in fact, a lot of the RBI actions were anticipated by the market, and quite often OIS rates don't move much because the RBI did what people expected it to do. So there it's a little bit different from South Africa. But then we find evidence that there is some communication that the market is gleaning from the statements. So the way I'll show you is that controlling for what happens to the short end of the OIS curve, the medium end, let's say 6 months to a year, moves independently. Okay, so it seems like the market is gleaning some information from what the RBI is saying, and I'll have more details to say about that. And then, as I mentioned, that we do this narrative analysis, which basically tells us that this approach is reasonable except for this 07 to early 09 period, where we know that even in the US, for example, there was some months where financial prices were kind of out of whack, if you will, like not consistent with no arbitrage stuff. And in India, that period seems to have lasted for longer. Okay, and then in terms of the transmission, we find that stock markets and bond markets respond in the way you would expect, but exchange rates don't. We can have a discussion about that. There's also a lot of heterogeneity based on who the governor of the RBI is, so we can also talk a little bit about that. And then when we look at transmission to real variables, we have some mixed results, so I'll get to that. Okay, so just a quick overview of kind of the background for the Reserve Bank of India. So until the early 90s, India had super strict capital controls and the exchange rate was completely pegged. And then since India had a balance of payment crisis in the early 90s, and they started relaxing capital controls slowly. And they also let the exchange rate depreciate, and has depreciated pretty much consistently since then. Even capital controls have been loosened somehow, although quite a few still remain. In terms of monetary policy, up until 2015, there was no specific dual mandate like we have for the Fed or inflation targeting. So I'm calling that, or people have called that, the multiple indicator approach. So they worry about inflation, output, but they worry about exchange rates, they worry about financial market prices, all sorts of things. And then in 2015, they start adopting this inflation targeting framework, and it's ratified in 2016, where now there is a 4% CPI inflation target with a 2% band around it. At the same time, there is this monetary policy committee that's formed. So this is a 6-member committee with 3 internal members of the RBI and 3 external members, and they vote on monetary policy decisions quite similar to the FOMC. Okay? In terms of the policy tools, the RBI has used many and still uses multiple ones. But before the early 2000s, this cash reserve ratio, which in the US would be like the required reserve ratio, that was kind of the primary tool. And since then, the repo rate has become the primary tool. With the adoption of inflation targeting, the repo rate was made explicitly the monetary policy tool. But even before then, the understanding was that a lot of the market was paying attention to the repo rate. Okay, so the first step of, please. No.
If I remember correctly, that there was an experiment in trying to incentivize people not to use cash, right? Is that something that's going to show up as a monetary policy anything?
Yes and no. So it's going to show up as so you're referring to this episode of Demonetization, which happened in November 2016. And there was an RBI meeting right after that, a few days after that. And the expectation was that the RBI would cut rates, and then they didn't. And so it'll be a monetary policy shock, but in a completely normal sort of way, that it was markets expected. So in fact, let me just skip a bunch and go to that, because this is one of the dates that we look at. So this is the 7th December meeting. And when we read the newspapers the day before that, there was an expectation that RBI will cut by 25 basis points, or some people even expected 50 basis point cut. But then there was no cut, and then the narrative analysis suggests that after the meeting, everybody was kind of surprised, and we get basically a contractionary shock of the size that you'd expect if there's some weighted average of an expectation of a 25 basis point and a 50 basis point cut.
The question I'm asking is slightly different in the sense that you know when the demonetization decision was announced.
Right.
You could look at the OIS rates on that day.
Yeah, not
and
much.
See whether people perceive this as a signal that the RBI is going to react to it.
Right. So exactly. So we've done that. So this expectation of between 25 and 50 basis points takes about 5 days to set in. So it's kind of gradual to set in. So it's not clear right away, because it's really a shock. Nobody really knows what to expect of it. Gradually, people start coalescing around this idea that this is going to be bad for the economy, at least in the short run, and then the expectation set in that this RBI will have to cut to manage the economy.
Okay.
Yeah. But it's not in the paper, but we did look at that data.
Super.
Okay. So let me go back. Yeah. Okay. So we're going to use OIS rates because we found that these are effectively something that has been used in contexts outside of India. So there's this nice paper by Lloyd that shows that if you're trying to predict what future short rates will be using OIS rates, then they seem to be reasonable things to predict with for the US, the UK, Eurozone, and Japan. And then as we started writing this paper, there was a paper written by some people at the RBI that did the same exercise. It's effectively just looking at excess returns from using OIS rates to predict this, and you don't find much evidence of excess returns. So they seem to be reasonable predictors of what RBI is going to do, even for India. Okay, but we're going to show some evidence on the day of the RBI announcement that these things are also reasonable. Right, as I mentioned, the key component of our analysis will be, we'll look at how these things change on the day of the announcement, and that's going to be the monetary policy shock measure. So here's a simple summary stats table. I have a bunch of OIS contracts of different maturities, and then the first 3 columns are what happens on the announcement day, and then the next 3 are what happens on all other days. So what I want you to focus on here is just the standard deviation, effectively saying that on RBI announcement days, these rates tend to move more than other dates, and we've done this comparison with other news releases, like the GDP release, and we still find that the RBI day is one of the most important news days in India. Okay, so one natural question, again, going off of what was presented in the earlier paper, is that you should expect some relationship in how these things move, right? That if the short rate moves, there should be, because of the term structure, some effect on the medium to longer rate as well. And so one question was, is there any independent movement in the long rate once you account for the short rate? And so we do something very similar to what you guys did, which is we look at a principal component analysis, right? And as Rafet was recommending, we look at how much of the variation in these contracts is explained by the principal components. And here, it's clear that the first 2 are effectively explaining almost everything, right? And we also did the formal wall test, and you get that you have 2 factors, which you can kind of clearly see from here. And as was mentioned again, which is that this is just a statistical thing of figuring out how to explain these things. There's not much economic structure here. And so we'll do, again, the similar thing that you saw already, which is we're going to rotate these factors to have a target factor and a path factor. So let me show you what they are, and then let me give you a simple intuitive interpretation, which is that effectively for the Indian data, the target factor, you can think about it as just the change in the 1-month OIS rate. Right? So it's the surprise change in the short-term interest rate. And then the path factor is effectively the following, which is you take the change in the 1-year OIS rate, you regress it on the change in the 1-month OIS rate, and the residual from that regression is the path factor. The correlation with that is about 0.97. Okay, so it's movement in the 1-year rate independent of movement in short rates. Okay, so this is what the series looks like. These are different governor regimes. We've kind of, in this MPC regime, we've combined 2 governors because there's not that much data, but we could do even more detailed stuff. Okay, right. So then we spent.
I understand the rotation of vectors.
Uh-huh.
And that's a continuous thing. And then the eigenvector you would get from the rotation you like. One of them isolates the linear combination that gives you 85%. It seems to me it looks like one factor, but anyway, you get 85% for
Right.
one and 15 for the other.
Right.
Now, can you explain how can you explain the way you choose the rotation as according to what the weights are?
Yeah,
Can you
so-
see it in that type of language?
Yes. So I don't have the figure here, but it's in the paper. So
kind of an intuitive
yeah, so the intuitive way would be that if you look at, say these guys, right? That by construction, the path factor explains 0% of the variation in here. And then,
There's the first, the principle, the most important thing,
uh-huh.
is that the path?
What do you mean most important?
Well, so you have 5 components.
Oh, I see. Yeah, no, right. So you want me to do the decomposition after doing the rotation, and
Yes.
and the target factor is more important than the path factor. So I don't have that, but it's something like 60.
It would depend on which maturity you're looking at.
Right, of course, exactly. But that's exactly what I was trying to say, that for the 1 month, the path factor is irrelevant, and for the 1 year, the path factor is more important than the target factor. But for these ones, the target is more. So it kind of changed. So I have this table, sorry, I don't have it here in the paper. I have this table, yeah. Okay, so let me go to the narrative analysis. Yeah, so I think I've already explained what we do and why we do it. I already ran you through this particular example. Let me give you just one more example, which was October 2011, where the expectation was that there would be a hike at the meeting, and then there was a hike. And so the target factor is effectively 0, which is consistent with the idea that the market expected the RBI to raise, and they raised rates. But then there was this one line in the statement that was mentioned in many different articles, which is that further rate hikes may not be warranted. So the market took this as a clear example that this is a sign about looser monetary policy in the future, and then we get a negative realization of the path factor consistent with that. Okay? So I'm showing you this particular example. In fact, this is one of the outliers. So when we do this more broadly, so let me skip this for a second. We find that, like we found that specific statement about forward guidance from the RBI, on a generic average RBI announcement day, they don't have any one particular statement that the media kind of highlights a lot. So generally speaking, the statements are long, they're confusing. You could look at certain parts and think that this is hawkish. You could look at other parts and think this is dovish. But there still seems to be somehow the markets are kind of extracting some information from that. And in fact, this is consistent with what the RBI's official stance is on forward guidance, which is that they don't want to provide explicit forward guidance, but have a preference for market participants to draw their own inferences. Okay? So this official statement was in place until 2019. Since then,
invalidates the whole point of forward guidance, right?
I think that this is the official statement, but de facto, this is, the market expects that sometimes they will be clear, but most of the times they won't. So in fact, I'll show you some evidence for that quickly, which is, in the last couple of minutes that I have, let me show you just the financial market response. And I skipped one more, so let me go back over here, which is that when we did this narrative analysis, we found certain dates where the factors were telling us something really crazy, right? Which is the RBI cut rates by 25 basis points, but you still get an expansionary 1.5% shock. And in the media discussion, there is no discussion of how, because this would mean that the markets were expecting the RBI to raise rates by a tremendous amount, by like 2%, and they're not doing it. And there was no mention in the news articles about that. And this was kind of a theme that around this period, we saw lots of crazy movement in OIS rates that were not consistent with what the RBI was saying or doing and what the markets were discussing in terms of the news, financial market participants giving news interviews to the news media. So what we're basically saying is that OIS rates are good for India, but not for this period. Okay, and so here's one pitfall for just taking financial market data for countries like India, where you have to be a bit careful, because this is an over-the-counter security. It's tough to get high-frequency liquidity data, so it's tough to know whether these things are reasonable or not. So we're advocating some caution in just using these things without carefully paying attention to the sample. Okay, so in terms of the monetary transmission, what we're doing is just regressing different financial markets. So these are bond yields, this is the stock index, this is the exchange rate on both the target and the path factor. And we find evidence that after a contractionary shock, bond yields go up, stock prices go down, but not much happens to exchange rates. Okay, and in the discussion, I'm sure we can talk about this, but lots of reasons, capital controls, the market does expect the RBI to intervene from time to time, so we can continue that discussion. So let me end with one last table, which is that when we do this transmission governor by governor, we find quite a lot of difference. So for example, under Rajan, all the action was in the path factor. So it's all forward guidance, right? So when he changes interest rates, markets completely anticipated that. So all the action is on, bond yields are only moving based on the statement rather than the action. But then when he's replaced by Urjit Patel and Shaktikant Das under the MPC, it completely reverses. So now path factor is no longer related to the yield, but it's all about surprise changes to the interest rate. So we have some more analysis on this, doing a pre and post IT stuff. I can talk about it more, but yeah.
So there are two ways of finding the insignificance. One of them is there are surprises, but the market doesn't react to them. The other one is there is no identifying variation, right?
Right.
So there are no surprises, hence no reaction.
That's right.
Which one is it?
Yeah, so good question. So for Rajan, it's both. There's just, so I can go back to the original figure where I show you, yeah. These things are quite small, but these things are not.
Yeah.
And here they're now, right after him, they're a bit bigger. So it's a bit of both.
So for Rajan, it seems like it must be decent forward guidance,
Yes.
where people understand what is coming, and therefore there are no target surprises, and thus no market reaction to
That's
them.
right. That's
Okay.
right. That's exactly right. Yeah. And then, since I don't want to go too much over time, we did some VAR stuff in the way that you guys did too, using it as external instrument. So we use the path factor to instrument for the 1-year OIS rate, because we found that the target factor was a weak instrument. And we get it's kind of mixed results. So inflation falls, as you'd expect, with an increase in interest rate, but output goes up, which would be the opposite. And then in the monthly stuff, we find the exchange rate moves in the way you expect, but not high frequency. So there's some inconsistency here, and I think we need to do more work here. But let me conclude, which is that I'm excited that lots of other people are working on this idea. So hopefully we can get the message out that it's okay to write papers on specific countries, and hopefully, journal editors will be more receptive for that. But also that if people want to do any work on India, then please use our shocks. They're publicly available. Yeah.
Take the computer. Oh, yeah, perfect. Giovanni, let me connect the computer.
Sorry.
Yeah.
Do you have the...
I just put it there.
Perfect. Thank you. Metti full screen.
Giovanni.
All right. So I should thank the organizer for letting me read these papers. And this is, of course, you might guess, it's a paper I very much like. It's a line of research. I think it's important. And actually, it's a very interesting paper. As was mentioned a few minutes ago, all of what we know basically from modern methods about monetary policy comes from advanced economies, almost entirely from the US, plus bits and pieces from Euro area and the UK, maybe Canada. But there's little research done about monetary policy with modern methods. And when I say monetary policy in emerging markets, I mean really when changes, there are changes to rates. I'm not thinking about all of the good stuff we've seen since this morning and yesterday about capital flows, etc. Now, this paper tries and fill this gap. I think it's an important gap and it's an interesting gap, and try to explain why I think it's interesting, and not just for emerging markets. What they do, very quick summary, they look at daily changes in OAS forward rates from 1 month to a year, 115 announcements. They extract, with the methods that was pioneered by Refet and Quarters, they extract the path factor and target factor. We're all familiar with that. And then they supplement these factors that come from high-frequency movements in financial markets with lots of narrative to try and make sense of them. And then they use these objects in an event study work, in a sort of standard event study, and then to extract impulse response function, dynamic responses that we should interpret as causal responses of the economy to a shock of some nature. Now, the results are that bonded stocks react strongly to these surprises. That comes from the event study, all great. But there's a lot of, let's say, quote-unquote, unexplained heterogeneity, both over time in the volatility of the surprises, but also across governance. And that's a bit of a puzzle. And on top of that, the macro effects that you can find are quite puzzling. So there's a big question, what are they? So I'll try and discuss a bit that, what we could do, what can be done to try and understand why these effects are puzzling. Now, the first comment I want to make is, why emerging markets are complicated. We know, right? Poor data, volatility in the data, not very deep markets, instability in the policy rule, unstable policy framework, all of that. Now, this paper does a very good job in trying to address as much as possible these things. And in discussing with different tools, narrative, etc., those problems, and trying to provide appraisal of these problems. Now, of course, there's a lot more, because we know that the policy framework is unstable sometimes because there are many goals, and these many goals sometimes are supplemented by other tools that are out of the picture here. We were talking about demonetization, for example, but there's a lot more happening in the background that you don't capture. But also because the policy reaction function changes over time, perhaps. We saw that across governance, but it's also less well understood by the agents. So there's a problem of communication. And then, of course, we know there's a huge role for risk premia potential that are triggered by the communication. That was our sort of discussion earlier on. And there's also potentially bigger role for external shocks. Now, these points are also the points that make emerging markets interesting, not just complicated. Because when we think about some of the puzzles we have in advanced economies as well, they might come from risk premium, or they might come from communication. So if we can understand what is happening in a lab, let's say, in which things are more visible and more upfront, then perhaps we can understand better how to manage communication, how to manage risk premium in advanced economies as well. I think there's a lot to learn here. My second comment is about where essentially the missing interpretation is in this paper, and where there's perhaps some work that could be done, and is about the interpretation of these objects. So we have these high-frequency movements. What are they? Now, if you look at how macro variables respond, you see that there are a few problems. First of all, industrial production goes up when there's a tightening, let's say, of the conventional monetary policy. So there's something we could potentially learn. My third comment is almost about language, because the paper makes uses almost as equivalent shocks and surprises. And the point is that these are not the same thing. Now, monetary surprises are news with respect to the information set of market participants. Structural shocks are instead the unforecastable stochastic disturbances in the economy. Now, in order to identify the effects of monetary policy, we need innovations that are news to the agent, unforecastable, but also that are orthogonal to the state of the economy. Now, in a full information rational expectation model, the two coincide. What is news to markets is a structural shock. There's no other way around. However, when you start deviating from full information or rational expectation, or both, say you don't know the rule, or you have some beliefs about the rule, or you don't know exactly what is the state of the economy, then problems come in, because there is not anymore a one-to-one map between surprises and shocks, but many things can happen here. And that's essentially the key difference with the rational expectation econometrics from the 80s and what we do today. Now, the question is, what kind of information is in the surprises, and can we decompose these surprises into monetary policy shocks? Now, let me, to give you a bit of a sense of what can happen, use a Taylor rule, right? There will be a response to inflation gap, a response to output gap, some anticipated deviations, and a monetary policy shock. Now, what happens when there is a monetary policy announcement? Well, if you are in full information rational expectation, the difference between your expectations a moment before and the realization is just a monetary policy shock, nothing else. However, we know that there's a literature now telling us that actually there are information effects, and therefore there's some disclosure potential information about the cyclical position of the economy as assessed by the bank. And there's also a literature saying, well, perhaps there's information about the long run R star, the national interest rate. I'm not a strong believer of that, but perhaps you can make the argument. More information. But also, if you don't know the rule, you might be updating your beliefs about the coefficients of the rules. And this will induce a response as well. And finally, you can have risk premium. So all of these things are potentially blended into these surprises. And in emerging markets, probably we'll have all of them. Now the question is, can we do something about that? I don't have an answer, but I know that potentially is an interesting question. And there are different methods we have been using so far. One is a survey-based, and the other one is market-based. And Refet was mentioning them before. Survey-based means we use forecasts, either from the agents or the central banks, to try and disentangle the informational component from the surprises. Market-based, we look at different asset classes, let's say the stock market or perhaps some spreads, and we try and understand how markets understood in real time these announcements. So it's not anymore from the information point of view of the central bank, it's entirely from the market point of view. Now, this has been used basically just for information effects, but perhaps you can do more, and there are good sort of ways to go around to try and capture perhaps changes to the perceived policy rule and perhaps changes to risk premium. Now, if we can do that and we can unpack these surprises, then we have a nice map, and then perhaps we can understand better the effects of monetary policy. And perhaps we can then extend these methods to advanced economies, helping our colleagues there. Now, does it matter? Yeah, it does. So just let me show you, for example, the forward guidance surprises, the path factor from the US, when it is decomposed using the information set of the central bank in the exogenous monetary policy component and the information. Now, as you can see, the puzzles are gone if you try without the puzzles. And the forward guidance, the exogenous monetary policy shows contraction effects. This is a contraction surprise, while the information is a demand shock, essentially. So there's something to be learned there. So conclusion, super interesting paper. I learned a lot reading it. It's one of the first papers bridging and adapting high-frequency identification to emerging markets. It's a very interesting exercise to understand how monetary policy works in emerging markets, but also in advanced economies, and brings in some really, really important questions about how we identify causal effects. And that's, I think, where the real sort of traction this paper can come from. Thanks so much.
Question? Questions, or you want to?
You can take questions or I can
Yes.
answer.
There's
I mean,
Matthew.
maybe it's got a question mark added, but it's probably more of a comment. So looking at your paper, the first thing about it is it's very easy to read, it's very clearly written. And that's essentially where my comment comes from, because your paper is about two things and the interrelationship between two things. The first being the system of prices and the level of those prices and the relative distance between those prices, and the second being the system of communication. And there's this kind of robust analysis, which is repeated in Giovanni's comments about the prices. But what are we doing on the analysis of the communication? Now, I read in your paper that you did a narrative review where you read leading news agencies. And then you arrived at a conclusion about what that objectively meant. But language is also something you can measure.
Yeah. So
Statistically.
Right.
And clarity of language is something you can begin to measure. Are we linking up the robustness of the price analysis sufficiently with robustness on the communication analysis? I mean, probably not enough time to answer that, but
I can answer. Actually, that's a great question. So my co-author has done some work on exactly that, to use some of these linguistic methods to analyze the statements. And it's a bit tricky because these statements are really long. And unlike, say, the FOMC statement, which is like a couple of paragraphs. So there's something to be gleaned from like the tone and things like that, but it doesn't help us directly answer this issue of, is the OIS data reliable? Because we can't find a nice one-to-one mapping from that sort of linguistic analysis to the finish.
Add something to this?
Yeah, please.
The general problem here, and I've tried, he's tried, many other people have tried. We all fail colossally because the NLP whatnot methods are very good in quantifying the statements. We can also measure the clarity. That's also fine. But the issue here is this is all about the unexpected component, the surprise in the statement. And measuring the level of the statement is easy. Finding the surprise in that language, you don't know where to begin. And that's where we all hit the wall.
Yeah, exactly right.
cool.
Yes, please.
So I had a more general comment regarding your last comment.
Okay.
That I'm trying to get papers of emerging markets published.
Yeah.
And we all know there is a bias. Clearly, when there is of the US, it gets published. And when it's of a country, then we need to claim that country is all emerging markets. Just to see if the editors have a little bit more sympathy. And I see the advantages of that, but I also see the disadvantages of that. We're putting very different countries in the same basket. And with different levels of heterogeneity of many types.
Right.
So for example, one thing that was mentioned is the poor data quality. That's not
always okay.
Always generalizable. But also, as you mentioned, not all emerging markets are trying to do the same thing.
Right.
Which also gets into different results. So again, the comment is in my mixed feelings when we try to be general and say emerging markets, but we all know that they're very different.
No, I completely agree. So when we first wrote this paper, the title was Measuring Monetary Policy Shocks in India.
And then
we sent it. We sent it a few places, and now that we've changed it to emerging countries and then evidence from India, and then it's a bit more. So I was very much in your line of thinking that this is an India specific paper.
But
And
then the way we make it general is not to claim 80% of the world population, or just India will claim that population. But what is the finding that makes it different?
yeah, so I think that's what journal editors are really after, is like what's novel here. And I guess my take is that I'm not that interested in that question. I'm more interested in maybe even like a descriptive analysis of like, nobody's done this before. I think that in and of itself is
No, but
interesting.
then you found something that is not the same as the US. That is what is making it different.
Right. So there is this issue that data is unreliable in certain periods. So there's some new stuff. But yeah, I think it's in some sense a philosophical issue of like, what do I think is the main point of this paper relative to trying to sell the paper? And I guess I'm a bit torn. I mean, I want to get it published, but at the same
No,
point,
you don't want to get that.
right. No, but that's a super important. Like I've thought about that quite a lot.
The governor angle is interesting. It's an interesting angle actually. I don't know whether it has been done ever in advanced economies, and I guess we expect that it's the same response regardless of governor. And that's an assumption. I don't know whether I've never seen it ever.
I once saw someone who was trying to go through all the vitas of the federal board members to see if there's something in the vitas to explain it. But I don't know if that paper. It was someone in Chile actually.
Actually, of all people,
Yeah.
journalists do a decent job where they look at the speeches and track, whose speeches elicits market reactions.
Right, that's right.
Right. And it's usually the governor, vice chair, and then at the FOMC, it's interesting to see, whether it's the voting members, non-voting members, the known doves versus hawks versus the, what is the term, the flipped votes. And that exists. And I have to say, it's not terribly interesting.
Well, it's interesting if you have I disagree actually. If the governor determine, a country can basically, depending on what they say and how they make decisions, can affect the response of all these variables, depending on who's around. In a country like India, which is a big country, then I think that's interesting. I think actually it's quite important.
The
Yeah,
interesting
no,
question here is whether the response is to the governor or to the communication strategy as a whole and the central bank as a whole.
Yeah, it could be other things, but that's still, the fact that you have in different tenure periods, different responses.
No, I agree. I think in India there was a big discussion of how communication from the RBI has changed since Rajan left. So I think that is definitely something people pay attention to. Yeah.
But even in the US now with power, there is a discussion of how he communicates relative to the previous.
Better central
And also, most people, if you read through Fed history, there's huge importance assigned to the personality of the Fed.
Right.
So conflicts between Lyndon Johnson and the government.
Hey, you wanted to sneak out without saying goodbye.
You must keep well, Nicola. And
Thank
we're
you
next to
very
in Cape Town. Let's-
Great to see you. Great for me.
Thank you.
Yes.
Come on, next to in Cape Town. Let us
Yeah.
Yeah, Burns and Nixon is pretty.
That's very controversial.
Miller?
He wasn't there long enough.
But in any case, the governor, the person of the governor, it shouldn't be that way, but I think the actual personality of the governor, the person makes a difference.
It does make a difference in the sense of, some governors are more political animals. Some governors are, more worried about output stabilization than inflation, right? You want to think of that as, very true. But so you may want to think of that as the governor, but you may alternatively think of it as the monetary policy reaction function under that governor. right? I don't know how to separate the
Change a lot, but roughly markets still understand it.
That's right. That's right.
With the Fed, Bernanke,
So Bernanke, for example,
was
you
a
can say,
massive, a massive change in communication.
but you can also say Bernanke is also a change in the policy rule. In the,
absolutely.
the price power was announced, and that's a huge change actually.
No, lots of changes.
Maybe you want
I was just going to address Giovanni. So thanks for the discussion. I completely agree with all your points. I think we wanted to do some more digging in the VAR stuff, and I think you've convinced us that we should do it more carefully. That's the equivalent of like Green Book forecasts. But we can do the second thing, which we can use publicly available information to see kind of what you guys do for South Africa, to see if any of that can, if there's any predictability and whether that matters or not. So for sure.
Any more questions? Thank you very much.
After this delicious lunch, so I hope we can finish promptly. Before I start, of course, the disclaimer applies. The views expressed in this paper do not represent those of the IMF Executive Board or its management. So let me jump right in. Over the past decade, we've really seen a surge in foreign currency denominated corporate bond issuance, here US dollar denominated bond issuance, by emerging market corporates. And this sprawl has attracted large capital inflows into these markets. So since then, a couple of papers have documented rising distressed risk and financial vulnerabilities of these heavily levered emerging market firms. So high leverage and potential currency mismatch on their balance sheets have sparked concerns that international investors may start to reassess the risks in these markets, reprice them, and pull out their funds on short notice. And so I think it is relevant to ask whether it is precisely the credit risks that emanate from the corporate sector in emerging market economies that can drive international capital flows. But why is the answer to that question not that trivial?